Welcome. After more than 500 episodes, I have decided to give the Fintech One-on-One podcast a bit of a refresh. You'll notice new music, a new intro, better sound quality, and some more subtle differences as well. And we'll also be launching some new features soon. Of course, you still get the same quality interviews that have made this one of the most downloaded podcasts in fintech.
The one that is probably in some ways least impacted by the change in administration is 1033. And that's the open banking rule, of course. One, it is going to be impacted potentially by litigation, of course, in the Sixth Circuit. It was immediately sued by the large banks. So that is going to happen, right change or not. However, when we get to other rulemakings, the CFPB could say, I don't want to defend this thing actually, and make it a lot harder for it to withstand judgment in court. But on this one, 1033, this is not where the CFPB is going to focus its deregulatory attention, in my opinion.
This is the Fintech One-on-One podcast, the show for fintech enthusiasts looking to better understand the leaders shaping fintech and banking today. My name is Peter Renton, and since 2013, I've been conducting in-depth interviews with fintech founders and banking executives. On the show today, we have Armen Meyer, the co-founder of the American Fintech Council, the former head of public policy at Lending Club, and a public policy expert. Now, I wanted to get Armen on the show because I thought it'd be useful to get his perspective on the impact of the new Trump administration on fintech and banking. And we cover a lot of territory on the show today. We obviously talk about the changes that he expects to see at the leadership of the regulatory agencies. We talk about the CFPB in particular and what might happen to some of the rulemaking that's been going on there, like open banking, buy now, pay later, credit card late fees, and more. We talk about the bank-fintech partnership model and what this might mean as it's been under attack for some time now. We also talk about the Chevron doctrine and what that might mean. We discuss Project 2025 and the potential fintech charter or a limited charter of some sort, and much more. Now let's get on with the show. Welcome to the podcast, Armen.
Peter, great to be here.
Great to have you. I know we go back a few years. I was just reflecting, we first met at, I think it was a Marketplace Lending Association, obviously the precursor to the AFC, at the 2017 event in DC, at a bar, I think it was. But anyway.
All good things start at bars, apparently.
Yeah, I know you're at Lending Club for a long time, but why don't you hit on some of the highlights of what you've done in your career to date?
Well, yeah, when I met you that day, I was just coming out of a 6-year stint at PricewaterhouseCoopers, where I had been a management consultant and helping clients implement this thing that we don't talk anywhere near as much about anymore, the Dodd-Frank Act.
Right.
And this other thing we don't talk about very much anymore, the global financial crisis. I spent the last 6 years when I met you working with the bigger banks. And then as time went on, during those 6 years, I realized the fintechs were much more interesting. And then that's what brought me to Lending Club in 2017, which is where I met you. And I know we're going to get into this panel, but the Trump administration then created a lot of opportunity that was different from what was happening under the then Obama administration, going from re-regulating the economy to now, what is this fintech thing? How do we deregulate a little to make room for this technology that's coming in? And that's why Lending Club was such a fun job for 6 years until recently. Where were able to, I focused primarily on, do we buy a bank? Do we take up this crazy thing called the OCC Fintech Charter? So a lot of the work around Lending Club becoming a bank, I was really happy to be a major part of. But then also, how does fintech engage with the world, not just regulators, not just Congress, but the entire policymaking community that includes consumer groups, includes community groups, includes nonprofits. And we did then rebrand and really change that Marketplace Lending Association. And I was proud to co-found a lending club, the American Fintech Council. I should warn, I left there about a year ago, thanks to the great Phil Goldfeder, who we brought in. My services were no longer needed, not that they were ever needed, but it was really fun co-founding that. I was glad he took the job as CEO, and I left Lending Club, and I'm now doing my own thing, advising companies on kind of my bread and butter, which is how you think about regulatory change, how you create lasting regimes in your organization that don't just check boxes, but satisfy stakeholders, and more importantly, are long-lasting and make you profit in the long run, so that when a financial crisis comes, you're one of the survivors, not one of the losers. Right. And we've seen a couple of those, right, in our careers in just the last 12 years, right?
Yes, indeed. So anyway, we're going to be talking about regulatory change today. That's going to be a major theme throughout our discussion. So let's maybe just kick it straight off with, what do you think, in the short term, the changes we're going to see at the regulatory agencies? Like, I'm talking like the first 3 to 6 months of the Trump administration.
Oh yeah, I mean, in the first 3 months, and then we can do the 3 to 6. Okay. Very easy. Here's how it goes, right? Number one, change at the top where possible. Number two, rulemakings, because those are subject to this thing called Congressional Review Act, which we'll get into. So it's got to happen quick, some of the rulemakings that were outstanding from the prior administration. And then you get into supervision enforcement. So starting with the heads of the agencies, which is, I would say in the first 3 months, the two agency heads that will not be there anymore is at the CFPB, Rohit Chopra, and at the OCC, Acting Controller Sue. Why those two? Controller Sue is in acting capacity, and Director Chopra is subject to a Supreme Court decision that said you don't get to stay a 5-year term at the CFPB. It was a 2020 decision. You instead are subject to presidential desires. I think, by the way, that's a terrible thing. Sidetrack, because it's very important. I think it's really bad that our regulatory architecture swings so quickly. I do like the idea of these structured boards, but I'm not in charge. So I'd like to see, I would like to see Director Chopra stay for another year. I know it's not popular with many, but I also want to see Kathy Kreninger stay as well when she was forced out for the same reason.
Right.
But those were the first two moves. But then I think when we get to 3 to 6 months, on the other end, we won't yet have change at the Federal Reserve, I don't think. Why? Because that is your traditional board structure, where board member by board member has very long terms. There's so much focus now on Powell, of course, but Powell has to stay. Why does he have to stay? He cannot allow the president to fire him. He's an institutionalist. He loves his record. So if there is any talk of firing, he will stay and he will litigate. Because under the law, he's probably on strong footing, and on precedent, he's on excellent footing. That's not happened before. And Mike Barr, who's the vice chair of supervision, very relevant to fintech, more relevant to the big banks. Also, I think likely to stay a while. He has a term as chair. It does expire, but Randy Quarles, who had his job under Trump, stuck around for about a year under Biden. And I think that kind of continuity is good and what we all would want to see. And I think in the middle, if I'm talking about like the 4 major agencies that impact fintech, we could do SEC and CFTC, but now we're in crypto land and that's important, but we could talk 7 years on those topics. But I think you got to look at the FDIC as where things will be very interesting and reasonable people would very much disagree what happens. I'm landing in the camp that the chairman, whose name is Marty Gruenberg, who's been at the FDIC for about 2 decades, has been chairman before in multiple stints, will stay. Why will he stay? Because the FDIC traditionally has a term structure, and only about 4 years ago was that violated by what I think is an unfortunate event. The new Democrats that came on the FDIC board kind of made Trump's appointee, McWilliams' life miserable. And you do have powers under FDIC rules to make it difficult for a chairperson to set agenda and drive their priorities. And that is what happened. But it wasn't like she got fired, but she did resign because of that. Marty, however, a huge institutionalist, a creature of the FDIC, is going to have a different attitude about staying or leaving, I think, than Chair McWilliams did. Now, what's going to happen? I said the 2 people that changed first are the CFPB and the OCC. Well, guess what? Both of those are on the FDIC board. Right. So pretty quickly, Marty is going to have to face 4 Republicans by himself, because there's 2 other members who are Republican right now, Travis Hill and an independent. They might take the independent may leave to preserve a 3-2 normal split, but nothing's normal anymore. So Marty's going to be in this strange world where it could be 1 against 4, 2 against 3. And we'll see, he's a fighter. We'll see what he does. The irony of ironies is that the Democrats, the liberals, the progressives have been pushing him out for the last year due to some serious scandal at the agency. He said, I plan to resign. I expect to resign. He never resigned. Right. So he chose his words carefully. So those who think he's resigned already and all we need is a new appointment, I don't think they're right. And why does this matter? We'll get into it. But of course, the FDIC really matters to fintech.
Yeah, for sure. But I want to dive into the CFPB because, as you said, that's going to happen pretty quickly. Is that the agency that you would say is going to be most impacted by a Trump presidency?
I think the noise will be at the Fed, but the action will be at the CFPB.
Right.
CE Project 2025. CFPB is listed nowhere near as frequently as the Fed. There's also this guy named Elon Musk who rants and raves about the Fed. He will have some importance in administration, without a doubt.
Right.
So the Fed, there'll be a lot of noise. We can talk more about if any of that is reality. But the CFPB is hard reality. Yeah,
well, let's maybe just touch on some of the big things that have happened in the CFPB. We just had last month, you and I are at the Philly Fed where Rohit Chopra launched the rules for open banking finally, and to much fanfare in the industry. And now, what's going to happen with Section 1033?
The one that is probably in some ways least impacted, in my opinion, by the change in administration is 1033. And that's the open banking rule, of course. Why do I say that? One, it is going to be impacted potentially by litigation, of course, in the Sixth Circuit. It was immediately sued by the large banks.
Right.
So that is going to happen, reg change or not. However, and we'll get to other rulemakings, the CFP could say, I don't want to defend this thing, actually, and make it a lot harder for it to withstand judgment in court. But on this one, 1033, this is not where the CFPB is going to focus its deregulatory attention, in my opinion, compared to many, many others. There are different types of regulation, right? This is like your classic Republicans and Democrats can agree regulation. This is infrastructure. This is creating pipes that make capitalism work or improve capitalism regulation. That is where you have the most consensus. The areas where CFP is going to get the most pushback are on the other areas of regulation. Those 2 camps are conduct restrictions, which often are called consumer protection, where the industry can't do things that it was doing before because of a rule change. Those are the ones that we should probably talk about, maybe go down one by one.
Right.
Transparency is the other one, and that one's kind of in the middle in terms of industry and consumers.
So I presume one of those ones you're talking about is the buy now, pay later rules, right? What do you think is going to happen there?
Yeah, so that's where we got to talk about the Congressional Review Act, which I don't think will be applied to open banking, but would be applied to buy now, pay later if it's what's in the window. It may not fall in the window of buy now, pay later rule. In other words, Congress, under the Congressional Review Act, may not be able to repeal the buy now, pay later final interpretive rule because it happened too early. Why would Congress want to repeal under the Congressional Review Act? Because you don't need 60 in the Senate, you only need 50. This was the playbook back in 2017 for repealing CFPB rules. You haven't heard of this thing called the ban on arbitration clauses since 2017 because it got repealed. So buy now, pay later could fall under that. Probably not, though. Under statute, that ability of Congress requires 60-day look back. And that's legislative days. That comes out to roughly 4 to 6 months. I think the BNPL final rule will fall out of that. So they're not going to be able to look at it in time. And the CFPB knew what it was doing when it finalized it that early to make it Congressional Review Act proof. So but the other 2 things we talked about stand. It's under lawsuit. The Financial Technology Association is suing, saying that you're misapplying the statute, the Truth in Lending Act. It's a common power of the CFPB to use TILA to create regulation. BNPL was another example of how they did it over the last 4 years. And they're saying, no, you can't do that. So will the CFPB, even though Congress can't repeal it, the CFPB could not defend, totally possible. Or the CFPB could just say, you know what? We don't love this new interpretive rule idea. This should have been done according to the Administrative Procedures Act. And they can just drop the whole thing and say, we don't like this interpretive rule idea. It should have been a proper notice and comment. That's a lot of the controversy, by the way, around that BNPL final interpretive rule, the lack of notice and comment.
Right.
So I think BNPL probably doesn't make it, not because of Congress.
What about the credit card late fees? What do you think about what's going to happen there?
That one clearly outside of Congress's purview, way too early. That's, of course, the one that caps late fees at $8, not $32. Again, TILA, you're noticing a pattern here. That's how the CFPB did it. But that one, industry hates, obviously. No one loves big credit card companies, though. The stock market thinks this thing is definitely toast. If you look at how those stocks in the credit card business went up after Trump victory, I would say it's probably not going to be vigorously defended. It probably dies in court. Definitely won't get CRA'd, as they say, by Congress, though, and probably doesn't get revisited. I think court is where this thing gets challenged and impacted and could go down.
Interesting. So what about the things that are sort of still a work in process? Like you've got the overdraft rules, you've got earned wage access, which has been watched closely by the industry. What do you think about some of those things?
Yeah, and the third one, which is the most interesting, is of course the large tech companies in the payment space. That is such an interesting one. But let's do the first two. Look, I don't think it's a coincidence that I'm not sitting here telling you all the regulations that Congress is going to repeal because the CFPB learned from last time. All of those were not finalized. Is it luck or is the CFPB really smart? I'm going to go with the latter. None of those were final. So now the CFPB has to look at what happened in the election. It's looking at the House of Representatives. It's looking at the Senate. And it's going to make a call. Do we finalize these rules or not? Because if they get CRA'd, not only does the rule go away, you can't regulate again under the CRA statute in that area. That's why arbitration didn't come back this time. They had to go around the rule another way, which wasn't as direct. So I think they got to make a tough call here, what they do. My gut is they'll try to finalize one or two of these big three outstanding, but that they won't do all of them because of the risk of not being addressed in the future. Or the new CFPB comes in. Well, if they don't finalize and a new CFPB comes in and just doesn't move them forward. But the most interesting one of these, so overdraft, we kind of know the politics around. Earned wage access, I think we kind of know the politics around. But the most interesting is the rule that says, hey, we're going to regulate the biggest tech companies that are involved in payments. And by regulate, I mean not just that we can create rules and enforce in court rules against you. We can actually go in, supervise, knock on your door. You got to let us in. We don't need a court order. You got to let us in. And they created that large participant rule, that's called, saying the large providers of payment services, we, the CFPB, should be able to look into. So here's where Elon Musk comes in again, which is going to be really interesting. Elon Musk has a payments company in his hand called X, formerly called Twitter. It's maybe not be there yet, but that is his vision. This is a guy who was very active, obviously, in PayPal. He had a neobank 20 years ago. I see him having a strong view here as to what he wants to happen. My gut is that CFPB wants to finalize this thing, get it out the door. Congress may or may not repeal, because who loves big tech these days? And Elon needs to catch up. He's not where he needs to be. We've seen his playbook with OpenAI and XAI, his company. He suddenly, after he leaves OpenAI, he's in favor of a moratorium on Gen AI research. That's going to give XAI time to catch up, that kind of rhetoric. And I do believe that a participant rule could give time to catch up to other payment companies that aren't quite there yet. So we'll see what happens. It's really complicated by the big tech politics, Elon Musk, and by the prospect of not being able to regulate again in the space if the CFPB actually finalizes. So this is a lot of moving parts.
Right. I know in the last Trump administration, the CFPB was really a hated entity, it seemed like, for a good chunk of that time, with a lot of people saying it should be legislated out of existence. I presume you think that's not on the cards at all.
Yeah, no, you nailed it. I think we're beyond those days, especially because we had that court decision this year where it was found the CFPB to be constitutional, not violative of the appropriations clause, because the money goes to the Fed and goes to CFPB, not directly to the CFPB was the argument. But that doesn't mean those who don't like the CFPB won't keep chipping at it. And so beyond what we talked about with recent rules, there will be creative arguments using the latest that's happened in the court system over the last 4 years to repeal even more rules, whether it's they were beyond their statutory scope, whether they violated some procedure. So I think 4 years from now, we're going to have fewer CFPB rules than when we started.
That's probably a pretty safe bet, I'm guessing. So what about there's been a flurry of consent orders particularly in the bank fintech partnership space, but so there's been banks that have received them, there's been fintechs. What do you think is going to happen to those companies that are operating under those orders?
So in the beginning, I mentioned kind of the 4 stages. And so we discussed heads of agencies, we discussed rules of the CFPB. There's, of course, rules of other agencies we can get into. But what you're getting into now, I think, is supervision, which is the last thing to change, really. Enforcement is kind of next. You start feeling the impact there. But here you're talking about, I'm a bank. I got hit with enforcement action quite a while ago, and I now need to comply with it. I think these are going to remain intact. No one wants to just lift up and undo these consent orders, but it'll be over time less challenging to satisfy the regulators that you have complied and can move forward. So I think those BaaS banks, I think those firms that are related to the BaaS banks will get out of their consent orders. This change makes it a little easier for them, but it's not like tomorrow these things go away. But they're going to have to do the work that they've been doing.
Right. So do you think then new consent orders will slow down? I mean, what do you think the impact of the new administration with the new leaderships of agencies, what impact is that going to have on the bank fintech partnership model?
Yeah, so when you get to new enforcement actions, I do think those do slow down. We definitely saw the CFPB, that happened. The CFPB moved from a regulatory enforcement agency to an education agency, really, under Kathy Kraninger, not completely, but for the most part. And we saw damages really go down. So we're going to see, I think, some settlements. We're not going to see wholesale dropping of claims in court. We'll see more settlements. We'll see lower dollar amounts. To your question on if there's a consent order about to come down, that's kind of in between supervision and enforcement. So the supervisors are the last to kind of change. I mean, I've been in some of these meetings in training sessions as a senior exec, or when I was a regulator at the Department of Financial Services, as it's called now, when I was chief of staff there. Everyone wishes they could control every member of their bureaucracy. You can't. So even if the new CFPB head or the new OCC or the new FDIC head wants to drop a lot of this stuff, you got to keep agency morale. A lot of decisions are made lower on the totem pole, especially at the smaller entities. So I don't think it's the end of all consent orders, but I do think that these companies have a second day in court to make their case. And by court, I mean to the top of the house agencies, to senior examiners. If they're on the fringe, I think that there is a chance that there'll be fewer than would have been expected over the next few months at the FDIC, at the OCC. But supervision and enforcement take time versus rules and change the top of the house.
Right. So then what about the states? When you mentioned you were at the New York DFS, obviously California takes the lead in a lot of consumer protection type legislation. What do you think is going to be the reaction of the states to the change of administration?
Yes, and this actually rounds out your question on the bank partner model. So what one hand give, one hand takes, right? So if there's less enforcement and a little bit less scrutiny on the supervisory side at the federal regulators as time goes on, I want to emphasize, I don't think the OCC and FDIC throw up their hands and say, you guys are all free to go. I really don't. I think scrutiny stands. It's at the margin, and over time it diminishes. But the other hand's going to take. Those are the states. I mean, I was a member of those calls when when George Bush was president about how the states need to do more than they had to before to fill in regulatory gaps, even before there was a CFPB. That attitude by states has only increased over time, not decreased. Right now, there's probably some state regulators talking to other, especially on the AG side, saying, what are we going to do to fill the void that's going to be left by the CFPB or the OCC or the FDIC? And I do think you're going to see states step up. New York did that immensely. Now, California is an interesting one, right? Because California just got only two. The AGs are going to do their thing. They're very powerful. They have this enforcement authority called UDAP. That Dodd-Frank Act we were talking about empowered them further to use that UDAP authority. What is that? Unfair, deceptive acts and practices. Basically means if you do something unfair or deceptive, I can bring a suit against you. Very powerful, right? It's not a clear violation of law. But California regulator now has that power itself, which is kind of new to have a state regulator, not just an AG, have these powers. DFS has a limited version of that, which we put in when I was leaving DFS, focusing more on deception. This will be a test for California, in my opinion. It's the first time we can see what they do. Will their budget go up? That will be your tell, right? Does suddenly the California legislature and Gavin Newsom increase their budget? It's a tough agency to play enforcement police for the country. So our first tell will be how the budget works there to know, will California step up and fill a void? New York traditionally does fill these voids, but the current commissioner is not Ben Lawsky, who I was there when he came in and succeeded Richard Neiman, who introduced us. The current person may or may not increase enforcement dramatically. I expect in some ways she will, and in some ways she won't.
Mm-hmm, mm-hmm. Okay, so maybe a sort of a more general question on the impact of this pendulum that we have going, Democrats had complete control of Congress just 4 years ago, or less than 4 years ago, and now we have Republicans complete control. We had Republicans had complete control in the first 2 years of the Trump administration, and so the pendulum keeps swinging back and forth. That doesn't seem like it's a good thing for the future of banking and fintech. What do you think?
It's a terrible thing for banking and fintech because it's terrible for our economy. And our economy needs stability to grow. Several of us wrote an op-ed saying, don't blow up the CFPB. That was Phil and I together at the American Fintech Council. Why did we say that? Do we love the CFPB? Not necessarily. But do we know that a lot of these rules of the road have been invested in and we want to move forward? That's reason number one, this is bad, the swings. Reason number two is these rules filled obvious regulatory gaps, which if we don't have filled, fly-by-nighters, those companies that don't necessarily plan to be around for the long run, will take advantage of those voids. So a lot of the rules we have in place make a lot of sense because companies, A, want to invest, B, they want to know they're not going to be undermined by fly-by-nighters who will take advantage of the very customers they're trying to help profit from and in the right way grow their companies. Three, I would say, in a world where we're just rolling back rules, re-implementing rules, I'm going to go back to your point, Peter, on what about the states or what about other agencies? Here you have people like me who've worked in industry, people saying we want rules of the road. Well, we have rules of the road. So if we start repealing rules of the road, what's left? What's left is UDAP, what I was referring to, which is very open-ended, very subjective. And we don't want to go back to that. A lot of these rules we want to keep in place. Not every rule, but we don't want a world where it's an open playing field for fly-by-nighters and for enterprising regulators to UDAP companies they don't like. So I lament, and I'll go back to what I said in the beginning, the 5-year structures helped a lot with this. And I'd like to see the FDIC 5-year structure respected. I'd like to see the CFPB 5-year structure. And I hope we don't have more degradation of this at the Fed. I think it'll be a very, very bad thing. If I could tell one more story that's relevant here. When Trump came in the first time, we were worried in industry. Oh no, you're talking about repealing a lot of fair lending enforcement around this thing called disparate impact, which is, are you fair in your outputs and your results, never mind on your inputs. several of us got together and we appealed to Director Kraninger under Trump. And we said, please don't roll that back. And before you look at us like we have four heads, the reason is because we have a regime where we can demonstrate to regulators, we being industry, that we're not being discriminatory. And we got to improve our technology and our data. And we know you're worried. We know AGs are worried. We know supervisors are worried as you increase tech, as you increase big data, see AI today, see Gen AI today, that we might be discriminatory in our outputs. So please, let's keep the regime so that we can invest in tech and data. You can sleep easy at night, and we don't have to worry about enterprising UDAP or some crazy new swing coming in the next election that undoes all the investment we just did to increase access to credit and to lower prices.
Right. Okay. So before I let you go, there's a couple of things I really want to get to. One of them is the Chevron doctrine, or the end of the Chevron doctrine, because that, the Supreme Court ruled, just earlier this year. What will this mean for the financial regulators going forward?
Well, thank God I went to law school, even though I barely use that degree and I'm much more a policy guy these days. So I can take a crack at this. Chevron for years has said when a statute is ambiguous, why don't we defer to the regulators rather than to the courts? So in other words, Congress didn't, depending on your perspective, fully do its job or intentionally deferred, because when you pass giant bills that change the economy, you can't get every single detail, and you don't want Congress to get every single detail. So you got to defer to someone. So the question is, who do you defer to? And there's this a raging debate. Do you defer to the experts in the agency, or do you defer to generalist judges? Now, I worked for a federal judge for a while in my 20s. We were very smart people, but we were not experts. And the amount of time and energy with a small office to learn major details on regulation is, I think, going to be a little overwhelming for the court. So what Chevron said was, judges, you got this. Regulators, you're out. We don't trust you anymore. So the Chevron deference was to the regulators. There's no longer deference. What's the impact besides overwhelmed courts and potentially bad outcomes, or maybe not bad, less expert-driven outcomes? Well, to the extent you're worried about the administrative state and you want more control over the regulators, this is a good thing. I just worry about what you're going to get out of the courts. I mean, I'll go into that more in a second. The other problem with this, well, not really a problem, is I don't think the impact's going to be huge at the CFPB. There's already been a roadmap for how to litigate CFPB rules, and that roadmap happened when there was deference. So I think Chevron deference is an interesting topic and it's fun to talk about, but it's actually not going to change the game all that much in terms of undermining rules. And I'm glad because, as you know, for the most part, I think the rules are what we need for a stable regime. What it might end up doing is backfiring. When industry needed rules, we went to the FDIC, we went to the OCC under Trump, and we said, hey, there's this crazy court case. Lo and behold, the courts get it wrong. And they did exactly the wrong thing. And this isn't just any court. This was the Second Circuit of the United States of America, the most financial-oriented circuit, which New York City is in. They got it so wrong that we're worried about the entire secondary market. We're worried about the growth of fintech. So we were so happy that the OCC had Chevron deference. We were so happy the FDIC had Chevron deference. And guess what? That case, I'm talking about, called Madden versus Midland, was essentially undermined and overruled by the courts. So I do worry about sometimes when you get what you ask for, you really get the wrong thing, especially when the folks who are against Chevron already kind of had what they wanted.
Right. Okay, so if you read through Project 2025, which I did a little bit this past weekend, there's an area in there about creating new charters for financial firms that eliminate activity restrictions and reduce regulations. So that it seems to me like there's a possibility, and obviously this is not a legislative document by any stretch of the imagination, but there's a possibility that we may see a new type of financial charter. What do you think?
Oh, I think without a doubt, if you're an OCC head coming in, you do want to figure out ways, and this is where policy flipped on its head, where the federal government, not the states, creates a charter that impacts 50 states. Without a doubt, there will be a proposal of some sort, whether it's in lending, as we saw under Obama, Tom Curry, which Lending Club hired me to take a look at, whether it's in payments, which we saw under the Trump administration, in crypto under Trump administration. There will be some other charge to propose. The question is, can we work with the states at a federal level, in the states with the federal government, to make it work, as opposed to the morass litigation that made the lending, what often people call the fintech charter, unworkable, because you just got the charter and guess what? You were in court the next day. So what was the point? So I think if anyone can, I do have optimism that we will find the right way of nationalizing some aspects of our regulation, because we have to. It has gotten a little, this is a state regulator talking here. We've gotten a little too balkanized. Not on every issue. It's worthwhile on some, but on some, we got to find a way of making this country more one country and not 50. And I do think some new charters could be helpful. I do want to be careful. I do think the states have a role to play. I do want to, if I can add, I'm optimistic, not just on charters. I'm optimistic also on open banking, because although that won't get shot down, it could get reopened. So we could see that open banking, which I think in some ways could have been more innovative, better for fintech, gets looked at again by the new administration. And two ways. One way is more power of not the banks that control the data, to use the data anonymously, respecting privacy, to generate new products and services. I think we need that in this economy where 6 banks control the vast, vast, vast majority of this data. It's not right to have that data in the hands of so few entities and to stifle innovation. So I want to see better on the open banking rule, and maybe we can get that this administration, because they're likely to redo the rule, is my guess. I'm also optimistic that this new administration is going to look at other sources of data in open banking to bring in. We got to do better than just credit card deposits. We need to bring in data that impacts consumers in other ways, and most importantly, underwriting. So see your data that's stuck at your employer, your data stuck at your landlord, your data stuck in your utility company. If these kinds of data can be used more openly to help you underwrite, to help a consumer make sure their credit scores aren't being negatively impacted unfairly to them, I think we'd be in a much better world. So I'm optimistic there. And finally, I'm just optimistic that the Trump administration will see the benefits of generative AI and AI to improve outcomes on regulatory compliance. We've seen so many great companies. We know their names, and I advise one of them called Fair Play, and there are others like Zest and Stratify, and many, many others, Spring Labs doing on consumer complaints, that are using AI to make the small banks' lives easier, so that we can have we don't have a trade-off between compliance and economic growth anymore. So I really hope this administration embraces some of these technologies so that we can reduce costs, have less consolidation to giant banks, have some great regional players, have some real competition, use open banking well, but then have this reg tech really drive the way forward for banking, so we're not bogged down in compliance costs. So I have some optimism there as well.
Okay, we'll have to leave it there. I'm glad you're optimistic. It's easy to kind of, fall into the sort of Trump is just going to tear everything down. And I think you've given us a good balanced sort of look at what's going to happen in fintech. So great to chat with you as always, Armen. Thanks for coming on the show.
My pleasure. Thanks for having me.
I always thought the biggest challenge when it comes to regulation for fintechs was this dual banking system and the often competing goals of state and federal regulators. Now, I know I'm going to annoy a lot of state regulators when I say this, but if you were creating a banking system from scratch today in this country, you would not create such a system. But in reality, I actually think a much bigger challenge for all fintechs and banks is this pendulum that keeps swinging back and forth between left-wing and right-wing governments. For all businesses to operate efficiently, they need continuity and certainty. And you simply no longer have that when you keep these wild swings happening. Anyway, that's it for today's show. If you enjoy these episodes, please go and leave a review on the podcast platform of your choice. And thank you so much for listening.